what are my best options for financing a small business? Well, your best option for financing a small business is to not have to finance it, to have a product or a service that people want, that they're prepared to pay for, and have enough profit margin built into it so that if you manage your cash flow properly, it could fund itself. Now, of course, that's wishful thinking because many entrepreneurs are not able to do that because they don't even really know what that actually means. So the best options for financing a small business tend to start with a credit card. And that's because most credit cards for a business are pretty easy to get. Once you've got yourself a business credit card, you can usually get a credit limit from maybe $5 to $25, or in some cases $50,000, depending on your business and kind of what it's about. And the ability to get approved for it, or the criteria that's required, isn't very high. So a lot of times you can begin with a credit card. You'll have to sign for it personally, most likely, like you'll be personally responsible for it, but it'll be in the name of the company. And then from there, what you move up into is typically a line of credit from your bank. Now, if you don't have a line of credit with your bank, it means your business probably isn't in a position to be able to afford one. The criteria that a business has to meet in order to get a line of credit in the name of the business is actually kind of high. So, the positive news, or the positive thing that comes with that, is if your business can get a line of credit in addition to its credit card, then that means you've probably got a pretty good business that the banks are interested in lending to. And that line of credit is typically based on the average amount of invoices that are outstanding with customers. So for example, your customers might not pay you the minute your service is done. They might pay you in 30 days, they might pay you in 60 days or 90 days. So you always have a balance of accounts receivable, money that you're expecting to receive from customers. The banks will traditionally lend you 75% of whatever that balance is. So after you've got the credit card, after you've gone ahead and gotten the line of credit, then the next piece of financing that you typically get is a term loan. And a term loan is usually 5 to 7 years, and it has a very specific purpose. Most uses for term loans include purchasing inventory, include purchasing equipment, include upgrading the space or the building or that your business operates out of. So you have to pay for maybe the counters or the furniture or things to do with your business because it's growing and your space needs to be able to accommodate the growth. And so businesses will give you a term loan for that. In between a credit card, a line of credit, and a term loan is something called working capital. And so accounts receivable financing is kind of the technical term for it. Factoring or invoice factoring is kind of the slang term for it. But what that basically means is that the bank didn't give you a line of credit because your business isn't in a position to actually qualify for one. But your business also doesn't need a term loan. You don't need a big chunk of money that you can pay back over the coming years. You just need some money to kind of make life work. So there are there are companies out there that will lend you money based on what's going on with your business. So if your business takes debit cards and credit cards, there are companies that will lend you money against the average volume of POS transactions that go through your credit card and debit card machine. There are other companies that will finance your invoices. So let's say in the previous example, you have a customer that owes you money, but they're not going to be paying you for 45 or 60 days. There are companies that will lend you up to, say, 80% of whatever that invoice is worth. And then when they are able to collect the money from that invoice, they will deduct what they lent you and then return the rest to you. So you can get a credit card, line of credit, a term loan. And in between all of that, you can get factoring or merchant advances or POS lending. Basically, a company will lend you money off of your cash flow. Now, I don't suggest these are best options for financing a business because they simply are just the options. I don't believe there is a best option for financing a business, depending on what its revenue is. But a small business that's got less than $5 million in revenue, you should be able to get by with a credit card, with a line of credit, and your business should be strong enough to be able to qualify for it so that you don't necessarily need to be using merchant advances or factoring or accounts receivable financing. So hopefully you find that helpful. I've got 22 years of brokering financing, and so if you've got some questions, feel free to ask them, post them on Quora, send them to me through any of the numerous channels that I'm on, and be happy to answer it for you. But I'm not sure there are best options. There are just simply options, and you have to decide when the best time to use them is.